Some people are a little bit blind to the potential risks. So there's the team has to be evaluated. Have they returned? What have they returned? Show me the returns you've given to your investors. Show it to me because everybody's got targeted 15, 20, 10, 11, whatever it is. And when I do the numbers, there's no way they can make those numbers because I like numbers and I got spreadsheets for everything. So, and I go, I don't believe that. And when I ask them to show me the actuals, many times they're not achieving actuals. So if you're going to invest your money as a passive investor, go with a team that has demonstrated full cycle deals and returns. If you're going to take people's money as an active investor, you need to do a lot of risk assessment of your criteria, of your projection.
If you've ever wondered how real estate investors actually build their businesses, not just the wins, but the setbacks, the pivots, and the lessons in between, you're in the right place. Welcome to Let's Talk Real Estate Investing, where we have honest conversations about what works, what fails, and what you need to know before your next move. Hi, I'm Debbie Balfour, real estate investor and investor success coach. I help real estate investors fund their deals through a relationship-first approach by building a pipeline of qualified investors who are ready to say yes to your next opportunity. Each week, I sit down with investors and industry professionals to unpack their journeys, key turning points, and practical strategies that you can apply right away. So let's talk real estate investing. You're asking about projected returns. You're asking the wrong question. The better question is, how is risk structured, managed, and mitigated before capital ever goes in? Because durable wealth isn't built on optimism. It's built on discipline. Today, we're going to go inside a risk management approach to multifamily, co-living, and land entitlement, and what it really takes to create long-term resilient wealth. I'm joined by my special guest today, Denise Evans, who is transitioned from senior public sector leadership and regulatory oversight into building and co-sponsoring real estate investments across Canada and the United States, bringing a policy-informed analytical lens to every opportunity she evaluates. This is such an important topic, and it's a topic I know so many of you real estate investors don't even want to think about because you think, I have to think negatively about things. And it also takes detail and planning, which most of you, I know it's our human bias to just want to jump in and implement and not to plan. Over to you, Denise. Welcome. I'm excited to get into this topic. Denise, when you look back at your transition from senior public sector leadership into real estate investing, what were the key inflection points that shaped how you evaluated opportunity and risk today?
Well, that's a big question. Prior to being in the public sector, I was also in private sector. And my education is the master's in accounting and policy and finance. So the first thing I do, and it's something that a lot of real estate investors and a lot of people in general aren't very comfortable with, is numbers. But really, when you're talking about a real estate investment, you're talking about numbers and risk related to those numbers. So the inflection point, if I understand your question, is when I was in public policy, I was also in economic portfolios. I worked in cabinet office. I worked under all three different governments in Ontario, Liberal, Conservative, and NDP. I worked in senior policy positions as a regulator and an infrastructure developer. The portfolios that are closest to real estate I was responsible for the highways from Niagara to Barrie to Port Hope, which is the central region of Ontario, the GTA, the busiest highways where we competed in terms of traffic volume with the busiest highway in North America, which was LA. Now, my responsibility was highway operations, maintenance, and operations, maintenance, and development. So there are those you can appreciate are big budget items. And we needed to make sure that we were managing that asset. When we're building that asset, it's very much like comparable to a house on a much bigger scale. You have electrical, landscape, mechanical, foundation, structural, all of those disciplines are brought to bear on any kind of highway or large infrastructure project. So those skills at a very high level were easily translatable into real estate. So that was an inflection point. I moved from public sector where I was not in control of my future and my destiny. I was at the mercy of someone else into private sector. I actually built and sold a technology company before I moved more heavily into real estate investing. And then, so it gave me that. So the inflection point was self determination, building my own wealth, legacy, and lifestyle, being in control of my lifestyle. I was also chief building official for the province, responsible for the building code. So, very much specifically familiar with small and large construction in the province, what the requirements are. And as a regulator, what it gives me, having been a regulator, having been in front of the building officials of Ontario, speaking to them, being part of the revamping of the Ontario Building Code, being part of putting in the first energy efficiency requirements into the Ontario Building Code, what that gave me was a very clear picture of how to deal with regulatory structures, municipal requirements, planning requirements, and the whole process of real estate development and modification.
You had that insider view from the government perspective and what they were looking for.
Correct. And a couple of the things that I believe in very strongly is if it doesn't work financially, even within government, because I was very fortunate. I had tremendous opportunities to make really material changes within government, material changes to how Ontario citizens and in some cases Canadians experience life. I was able to change graduated licensing. I put in place quite a number of policies, but fundamental to my process is if numbers don't work, nothing works and it won't stick. So if it financially does not make sense, it's no point going ahead. And that has served me well in public and um, private world. Now, what having worked before government in the private sector and then subsequent to government in the private sector, the other thing I believe in very strongly is that speed matters. Money like speed, wealth like speed, and anything that slows you down adds costs and risks to any project. So those are two of the things that, in terms of inflection points and differences from my one experience to another.
Was there a point in real estate investing when you got into real estate investing where it suddenly clicked that I'm not an outsider. I have all these skills and I should be bringing it to my real estate investing? Because I did that, treated mine as a hobby. And then I all of a sudden thought, I do this stuff every day in my 9 to 5 job. Why am I not applying it to my business? Did you have that same light bulb realization or endpoint? Or did you start out real estate investing going, oh, I need to do these things?
I've always loved the built form. I've always loved, so working in highways was great. I love seeing a change and making a change. I, my husband and I renovated 2 century homes and we went through all of the permit approval processes ourselves directly only because I love it and I wanted to know what it was. Anytime I hit a sticking point in anything, I go out and get myself educated on that. So the
Mhm.
first time I got refused for a mortgage, I went and did the mortgage broker course to find out what happened there. When we were doing our permits and plans for the century home renovations, I did it. I went to committee of adjustment. I handled all of those things with support, but I knew I wanted to know and understand that process. I think my love of housing and real estate started when I was 12 years old and I was doing napkin math with my dad because he bought and He had small multiplexes. He was an entrepreneur. He didn't have a pension. And those multiplexes are what funded his older age, his retirement. And I saw the benefit and legacy of what real estate can do for you. So I always loved real estate. I'm not sure that I felt as an outsider, but I really was not a sophisticated real estate investor. I was doing all those things, but I wasn't doing it from the perspective of what the mindset of a real estate investor. In that way, yes, that changed and that changed probably about 10, 15 years ago. I was buying things. I sold properties I should not have sold because I didn't know about refinance, for example. And I should have just kept them because they were excellent assets. But it was more, I've always loved real estate, not just in Canada, but in the US. Everywhere I go, all I'm doing is looking at real estate opportunities and what's happening in those markets.
That's wonderful. So, just quickly tell us a little bit about your journey. What did you start out doing in real estate, and how did that change over time?
So my first kind of our personal home was the first investment, but after that, I bought student rentals for when my kids went to university. I bought when my kids graduated from university, I bought small multis in markets that they could afford on their starter salaries with some support from us in the way of some assistance with deposits to get those done. So my journey was about how do I build lifestyle, wealth, and legacy. It's always been about that. How do we get to where we need to go in this world, which is very difficult, especially in the market that I'm at or where I was raising my family and my kids in Toronto, one of the most expensive markets, similar to yours, Vancouver, one of the most expensive housing markets in the country. So a lot of people are discouraged and can't aspire to home ownership, although that's changed in the last couple of years. Prices have dropped, and so it's a little bit more affordable. But the world is also more precarious and people are not as secure in their jobs. So that creates a lot of uncertainty for people. And one of the things that I help people do is point them towards, I do not act as an advisor. I am not offering tax or legal advice, but I point them towards strategies that assist them to build some wealth. So, for example, when somebody is young and does not have a house payment, a car payment, those other debts to service, they can qualify much more easily for rental properties. And those rental properties can then create cash flow, which actually assists them in debt service for a personal home if that's what they aspire to. I also look at, so that's kind of where I started from, trying to
Mhm.
help my kids, people I know, in wealth accumulation strategies that include real estate as well as non real estate wealth accumulation. I have my background is finance, so I've always been interested in money and wealth and what makes the world go round and the speed of money. And I look at markets, and I'm old enough to have been up and down multiple stock market cycles as well as multiple real estate market cycles. So I
Mhm.
do believe in diversifying your portfolio of assets and wealth. And I do believe that real estate is one of those areas where someone that has time and maybe not as much money can build some wealth using certain strategies and other strategies for people who have some money and no time. So there's a wide range. When you look around you, real estate is everywhere. It's ubiquitous in our world. And the opportunities and the structure of those opportunities and the types of opportunities are ubiquitous. But the risk is also there for sure.
So you came from that senior policy and regulatory background, managing complex systems, public budgets, and oversight of structures. So, how does that experience change the way you evaluate real estate opportunities compared to the average investor? What do you see that others might miss?
So when I first became, I'm going to be very frank, when I first became, quote, a real estate investor, because I had taken coaching programs and the world was really rosy in terms of real estate. I actually myself, even though in my professional life, everything is sensitivity analysis tested, interest rate, in many ways. depending on what the project was. Interest rates, with regards to real estate, it should be interest rates, rents, the markets, so on and so forth, economic growth rates, legal risks, and so on. When I first started, I was a little naive and participated in projects where I had not done the type of risk analysis that I should have. So today I have a portfolio of assets across Canada and in the US in different asset classes. And it depended because part of my strategy is it's lifestyle dependent. I also, or supportive, I also look at those things that will support where I want to be in 5 to 10 years in terms of where do I want to go visit or spend time. Where my family is distributed across Canada and the US. So it's again, where do I want to go? Are there opportunities there to create the opportunity for me to have a potentially tax advantage or revenue or income advantage opportunity to go see those things? So I have looked at multiple asset classes, and depending on the time and the cycle of real estate, I will look at different things. And I'll speak to that a little bit in a minute. But I do
Mhm.
have assets across short term, long term, multifamily, and multifamily assets across Canada and the US. I have different structures. I participate in different structures and I have different structures in terms of either shareholdings, GPLPs, direct ownership, JVs. I have an extensive background in all of those things. Because of that level of experience, because of what's been happening in the real estate market recently, I have, I would say, a kind of a broad understanding of what some of the risks are that new investors and new real estate participants should be looking at, as well as experienced ones. Shaping my view of the world and my idea of risk is fundamentally my finance background. Number one, it's about money, guys, no matter what. No matter what you want to do, it is in the end about money. I do a lot of, right now, I've shifted my focus to asset classes where I can expand attainable and affordable housing. I feel very strongly about that. I've kind of missed that in the last few years, having left public service. I did a lot of value add improvements. They just don't give me the level of satisfaction that adding housing stock at an affordable and attainable price does. So I've shifted in the last little while. And that's what I'm saying. People need to evaluate their lifestyle, their values, and what is actually going to give them the most personal satisfaction. Because being an employee, now I worked 60, 70 hours a week. People don't believe that in public sector, but I had very large portfolios. But as a real estate investor, you're on 24/7. It doesn't matter what day it is. It
Yes.
doesn't matter what time it is. It's a 24/7 job. So you better love it. You better love the part of real estate that you're doing. If you're doing it just because somebody said this is how you make money, it's not going to work. But at the same time, how do you assess? How do you manage the risk with each different type of opportunity? I see everywhere on Instagram, on Facebook, on everywhere claims of returns, targeted returns, target returns for this, target returns for that. One of the questions that I did not ask at the time, but it's a key one, and I have a kind of a risk analysis matrix that I go through because now what I do is I work with high net worth individuals to help them find above average returns in real estate investments. But one of the things that I did not know to ask was show me what returns you have actually delivered to your investors. Because targeted and projected, it doesn't matter what's targeted and projected. The first thing I ask is I look at the team that's sponsoring a project. And my first threshold now, and I learned that from my husband who was in corporate banking in Canada and the US for many years. His first criteria is who's the team? Have they done it before? Have they demonstrated success? Was it in terms of real estate, in the same asset class, in the same market, in the same type of project? So show me they have experience in that type of project, in that market, in that asset class.
And gone through every phase to completion and
Do
paid.
full cycle projects and tell me what you return to your investor.
Yes. And did you return it in the time promised?
Correct. Because time is money.
Mm-hmm.
And if a project extends because they didn't know what they were doing, or they didn't have contingency plans in place, or they underestimated certain phases of a project, that money disappears. As an investor, if you're in as equity, as an investor, not a lender, a lender is a completely different set of criteria. We could have a whole other session on that. As an investor, you
Mm-hmm.
get paid last after any lender, any debt, any other expenses. You're in there till the end. And if the project takes longer to complete, those returns evaporate. And in fact, the equity can evaporate, that your investment can evaporate, not just the returns, but the investment can evaporate. It's a very challenging environment. And so the first thing I say to people is look at the team. So for those people who are wanting to be an active investor, I always say find a team that you can work with or learn from that has done it before the life cycle, because every single asset class, this is the next thing, multifamily versus co-living versus long-term rental versus short-term rental, every single one has different criteria and different underwriting, a different way to assess the project and the risk. And some people are a little bit blind to the potential risks. So there's the team has to be evaluated. Have they returned? What have they returned? Show me the returns you've given to your investors. Show it to me, because everybody's got targeted 15, 20, 10, 11, whatever it is. And when I do the numbers, there's no way they can make those numbers, because I like numbers and I got spreadsheets for everything. So, and I go, I don't believe that. And when I ask them to show me the actuals, they're not achieving, many times they're not achieving actuals. So if you're going to invest your money as a passive investor, go with a team that has demonstrated full cycle deals and returns. If you're going to take people's money as an active investor, you need to do a lot of risk assessment of your criteria, of your projections.
What would be your top 5 risk, like right away off the top, that they need to be considering?
I'll speak to one asset class, multifamily, because that seems to be where it's very interesting, Debbie, that a lot of times people who don't know me or are new working with me, they say, but you're not enthusiastic. You're not like optimistic. And I said, if I am going to take people's money, because I am the investor relations person, I am very transparent. I communicate regularly. I'm trained to look at how the systems are designed, how the incentives are set up, and how the risk is where the risks are and how the risk is managed before I look at the upside. Because like Warren Buffett said, your first rule is don't lose money. So that's my first priority, is where are the risks that will result in the project failing and losing money? And I have to say, as I said earlier, I was not as disciplined about that in my own initial investments in the real estate community. I've become much more so. Surprised me that I didn't do that, because in my professional career, I did that all the time.
That's what I was
So,
mentioning before. That's what I was asking. I was the exact same way. I cowboyed it. And then when I started experiencing things in the business, I was like, Debbie, you go into organizations and you say, you got to do this, you have to do that. Where's our mitigation plan? Let's sit down and do these things. Let's put in systems and processes to improve things. And in my own business, I didn't do that. And then I had a light bulb moment 2 years or 3 years down the road that, oh my goodness, Debbie, this is not in your professional career. But for some reason, I created that mental block.
If you're looking to fund your next investment project, I've put together a free guide just for you. 5 fastest ways to fund your next investment project. Just comment guide and I'll send you the link to download.
well, I'd like to have a conversation with you to see what it was that caused us to do that. I have my own theory, but that's not the discussion for this podcast. But I'd love to have that conversation. I have a theory. I did the same thing, and I'm going, how can I have let myself do that? So I sat back down and I said, okay, So now I evaluate deals through governance and risk management lens. And I look for structured opportunities that can withstand market shifts, not just perform in ideal conditions. For example, in multifamily, there are a lot of people that, and I would put co-living in that as well. There are a lot of people that are relying on CMHC for their exit strategy because CMHC has some amazing programs with extended amortizations, lower interest rates, and very high loan to value opportunities. So, and I myself have done 3 full cycles of those projects in Alberta a while ago. The government, however, keeps changing the rules around those programs. And I say to people, if your deal won't work with standard underwriting, which is a lot more onerous than using CMHC underwriting, you are at risk because CMHC keeps changing their programs. Many times I've seen people presenting about their multifamily projects, their CMHC multifamily projects, and they are, because I was a regulator, because I was in government, I read the documents from front to back and all the rules. And in fact, on one of our projects, it was an 18-month project. We achieved it. We returned everybody's capital. We were, I think, 2 weeks later than our anticipated or target timeline, even with CMHC changing their rules twice in that process. The underwriting for those projects has got to account for significant risks. With what's happened over the last year or two, vacancy rates have increased materially. Rents have been pushed down materially. When you come to the point of getting the underwriting done and getting the financing from CMHC for some of these programs, the 85% loan to value or the 95% MLI Select, by the time you get to that point, you could not meet the requirements. So you should not count on those things. So here are some of the things that people have done that I've seen as the 5 pointers, but I don't know how to, at this point, I'm putting together, in fact, a framework, an investor decision kit for how they should evaluate different risks. The 3 things are the team, the asset class, and the market. And it changes depending on where you are, and it changes materially across the country with what's happening. There's lots of resources available out there. And so when you're evaluating an opportunity, CMHC puts out vacancy rates, rent rates, and so on. It's not the most timely, but it is pretty good in terms of giving us what we can actually access as investors in Canada, whether you're passive or active. Issues that have come up are, I'll tell you some things that have happened to me. I was in Belize for a month on the beach, and I got a call. I kept asking, where is the mortgage? We've had this mortgage with this mortgage broker for 12 months because it was a pre-construction property and it was going to qualify for CMHC 95% MLI Select. Well, CMHC changed some policies and some rules and put a bunch of lenders under audit. It came to the point that we were 10 days before closing and we did not have a mortgage. Now, this should not be a problem. The asset was amazing. The numbers were good. The market was good. What happened was CMHC caused turbulence in the market, and the people that we had engaged to get us the mortgage failed us. So I spent 2 weeks with my back to the beach on the phone, getting short-term bridge loans, getting increasingly better terms and opportunities to get a bridge loan until we could get a CMHC lender, an approved CMHC lender. This should not have happened. These are the kinds of crazy things that happen to real estate investors. And what we had to do, this was I don't know, I think let's for round numbers say it was a $4 million asset. And originally, all we had to put down was 5% deposit plus 5% maybe for all the costs. So 10% of 4 million is 400,000, which we had on account with them already done. Well, when you go for a bridge loan, bridge lender is not going to give you 95% loan to value. We started and we had 3 days to get this money in place. So we had to raise over $250,000 in additional capital for 10 days. I was fortunate with our reputation and my communication style, my directness. We were able to raise that money immediately or very quickly. We had to pay dearly for that money, of course, because people don't want to take the trouble of putting their money with you for 10 days or 2 weeks or a month. We weren't sure when we were going to get the CMHC funding done. CMHC certificates of insurance, when they're issued, have a time limit on them. And our builder had been delayed in completing the build. And so we actually only had 3 weeks or 2.5 weeks to get the full CMHC loan in place. So we had some risk as to whether we would be able to get it done. The certificate of insurance that had been submitted by the mortgage broker had multiple errors in it. I was successful in finding a CMHC lender, approved lender that would do the full loan. And we were successful in getting a really substantial bridge loan. Again, the rationale, the reason for that is my previous experience, my previous work experience, and my husband having been with a corporate banking in one of the large 5 banks. So reputation matters, your integrity and experience matters, and the experience of the team in being able to troubleshoot and get things done matters. And how committed are they? As I said, 2 weeks with my back, over 2 weeks with my back to the beach on a chair, calling and making calls and getting this stuff done and in place in order to resolve that issue. Now, typically that shouldn't happen, but those are the kinds of crazy things that do happen in real estate. More normally, you need to do sensitivity analysis for interest rates, for vacancy rates, for whether the CMHC loan will be there. CMHC has recently changed its vacancy rates for some of the markets. So people that entered into contracts a year ago, 2 years ago are now being challenged. This is a constant issue. So my preference is to do deals that no longer rely on changing government policy. Our government is struggling financially, and they're going to try and manage their risks just as we all have to manage our risks in terms of our finances. So I foresee increasingly more challenging criteria for multifamily properties.
So I hear some risks now, risk questions now from what you just said that people should be adding to their risk management plan. If they have a risk management plan, if they don't, they need to start one. But one is, what if I don't get the CMHC mortgage? What if policies and regulations change? What if my present mortgage that I think I'm securing doesn't come through? What am I going to do?
Changed, like more recently, they changed the immigration policies, correct?
From when one government is in that promises something and then a new government gets elected, those things
Correct.
happen.
Know when, so for example, if you're doing something that requires municipal approval, know when the next municipal election is. Know when the next, and whether that might impact your ability to get, it might impact it positively, it might impact it negatively. For those people that are looking for mid-rise and high-rise development or land assembly kinds of deals, they definitely need to be aware of what is going on in the minds of the people on council, on planning committee, and the other influences as to what will or will not be allowed. Like recently, Toronto loosened up a lot of regulations with regards to parking. Toronto does have a rooming house policy. So if you fall within that and you can use that, that's fine. Many other municipalities do not. So you really do need to know what's going on. If you are the proponent of a project, you need to know and understand what's going on. Some other more, in terms of the market. All right. More recently, we've had some announcements in this crazy economic turbulent time of plant closures, job layoffs. If you're in a town, a smaller community where there's this one single employer, you need to really understand what the future for that employer is before you go in there and decide you're going to do a value add. The other thing is to know what is the income level for that community. I have seen people go in, they put the proposals, I've seen them in front of me. They're going in and they're going to do a BRRR, which is a buy, renovate, rent and refinance strategy, a value add strategy. BRRR is used for smaller single family homes. Value add is the same strategy, but for larger multifamilies, where they're going to go in and put in high end finishes in a community that does not have the income levels to sustain rents at that high end level. The other thing to be very aware of is supply and demand. Go to the local building department, find out how many permits have been issued, how many projects have been started. What is the demand and supply? CMHC actually provides a really great report, and they did they periodically update it on where is supply and demand. So, for example, I stopped investing. Some people are going to be upset with me, but I stopped investing in the Calgary Edmonton corridor. I have properties there that I started 4 years ago, but now the supply demand, the amount of new construction is projected to outstrip the demand. Now, if we get a new pipeline announcement or more development in the oil fields, then perhaps that will change again. But I know, for example, the CMHC in some parts of Edmonton are underwriting deals with 10% vacancy. That was not something that was on people's radars or most proponents' radars 3 or 4 years ago. But I looked at it and said, okay, this is the CMHC financing is allowing so much new development that new development is coming on stream, and they are offering rent incentives and lower rents in order to be able to fill the units because they've made big investments there. So be aware of where you are. Look for those micro markets where the where supply is not going to outstrip demand and where you can find the opportunity to fill a gap. It's a lot of work. It's a lot of work to be an active real estate investor to find those opportunities. It's Canada and the US. The US is very different types of criteria. But the issues of the market, the asset class, the underwriting for that asset class, the market and the situations for that market and the team, those three categories have a lot of significant issues to put in there. I would put, like, for example, interest rates, vacancy rates. Interest rates are in the asset class, the impact of interest rates on that project and the value of the project, whereas vacancy rates is more a market specific issue. So
Yes.
look for teams that have experience in that particular asset class. And because, as I said at the beginning, I'm much more interested now in adding attainable, affordable housing into the marketplace, I am focused on adding housing in smaller markets in southwestern Ontario, which is still predicted to grow. It's one of the growth corridors, Toronto, Windsor. It's not the Toronto market. Toronto has its major challenges, but Toronto, Windsor corridor, there's still significant projected growth there. And people cannot afford to buy, even in markets like London and Kitchener, so on. So they're looking at the smaller markets. Vancouver, Victoria, similar story. The affordability issue is driving people out of those markets. So look to where the where supply is not outpacing demand in more affordable markets. Ontario, we are building in the subdivision, or we are getting a site plan approval. We're doing a land entitlement project where we anticipate giving investors about 30% return. That's our target. We've done it before. The team is very experienced in development. I've got my policy and regulatory background. We have a very supportive council, and we are looking at providing about 30% annual return to our investors. And it's like a 2.5 to 3 year project. Each class has different challenges. Each market has different challenges, and you need to look for the underlying strength and make sure that they've really assessed. Lots of people want to see the optimistic side of real estate. And I started to say earlier, sometimes people bring me on a team and they say, but you're not enthusiastic. You're asking all these questions. I said, that's my job. My job is to protect the project and my investors' risk. That's what I want to do. And so we also use an exempt market dealer for our deal. So they've done due diligence on the team and all that kind of stuff. So, and in
Well,
the
it
US,
sounds
the opportunity is where I believe the opportunity is in co-living, affordable living structures.
I switched my strategy from Airbnb when the government decided no more short-term rentals, and but I moved into co-living, and that's been lucrative and definitely better than having just renting out the house by itself. Some things that you said, Denise, is number one, what you said about the Calgary Edmonton market. That is like warning signs to me too, that when I see everybody going to one market, I run to the other because I know that it's going to be too much supply for the demand if everybody's going there.
A lot of large institutional money is going there too. Like they're building. So, for example, Nova Scotia and New Brunswick, those were small markets that nobody was really into. Canada is a
Mhm.
small market in general. So,
Yes.
institutional money is looking to build where they can get some returns. So, they're going into those smaller markets and they're competing directly with the
With the
smaller
smaller,
investors.
I looked at one of these development projects at one point, and then when we had a feasibility study, like I got all excited about the price and how much we could do, and then basically there wasn't enough demand for all the things we were planning to do there, and it's not a field of dreams a scenario where if you build it, they will come.
So
That's
that, for
reason.
example, with our project in Southwestern Ontario, one of the things we are doing is we went with a plan for 295 units, townhouses, single families, and small apartments, and the town wants more. Okay, you may want more, but if you can't sell more, if we can't sell the lots and the land, we're not really looking at that. So we have builders who have indicated they want to buy lots now before we actually get the site plan approved. So we are proving the concept and saying, what do you want to buy? Single family townhouses. The town wants more townhouses than single family because there's faster uptake, they're more affordable, and we can build them for a very affordable price. We got this land under contract for an amazing price 3 years ago. So it's very well priced and there is lots of demand and we have it. So we are testing. There's a few developers that do that. They're not just building to build, they're building with buyers in mind. And so you need to really dig deep into the team and ask every question you want. If they won't answer your question, if they can't give you the renovation plan or the Gantt chart, if it's multifamily, the renovation plan, if you're doing renovations, if they can't give you the Gantt chart for the development studies, if it's a development plan, if they can't give you how they're funding it, what's the capital stack, then stay away unless they're a very experienced team. There's very few people in the market today that can afford to just dismiss investor questions.
And I think
I
that's what's happened, Denise. We've seen it in our community that a lot of people that have lost their money investing because they didn't ask these questions and they went in with very young investors that had these grand ideas, but they did not have the experience.
Many of them grew too fast. That's the other thing. How many
Yes.
projects are you doing? Where is your attention? Because if you're starting with one or two projects, you can keep your attention on that. Like, for example, the multifamily assets that we did the value adds on, I was only running one project at a time there in terms of doing the tracking it. There's a lot of work that goes into managing and communicating to investors, keeping the lenders apprised of what's going on, getting the funds for the renovations and so on. There's two issues. One, the more expanded the team is, the more projects they have, the more distracted they are, the
Yep.
further away they are from the project. Many of these kind of MFT structures that have been put in place and other structures are very administration heavy. I had one guy, one Mick, tell me about a month and a half ago that they had invested $600,000, set up the MIC and administer the MIC because those things are very, they have, you have to have audited statements, you have to have, they're very administratively very heavy, burdensome. So that takes the money out of the pockets of the investors. And it
Yeah, because
also,
those are costs that are being set up that has nothing to do with the actual development.
right. And it also takes the direct relationship between the active partner and the passive partners, whether it's a GPLP or whatever, it one step removed. Because with an
Mhm.
MFT, they can have multiple projects. And many of the failures have happened because inexperienced operators thought real estate was easy and they took on too many projects with too much leverage, with too much distraction, without having the skills to be able to run and pivot on those projects.
Yeah.
And it's
Right.
unfortunate. A lot of high net worth individuals who started off passive investing in real estate have, in some cases, I don't know the number, I haven't asked and I don't know how to get that information, have lost their high net worth status.
Yep.
They've lost their accredited investor
A
status.
lot of people have had to go back to work when they were
The risk matrix, the risk strategies, the risk analysis is really important. And I don't care when my partners say, "You're asking so many questions." Run all the numbers and make it work no matter what. I go, okay, this, because my first job actually in the private sector was capital budgeting for like $50 million projects, 10-year contracts. And my job was to make sure those two things matched up and the company was making money. And they had a very high profit money requirement. And so I run the scenarios because for 10 years, commodity prices go up or down, or the interest rates go up or down, all those things. It's ingrained in me that I'm going to do it and run it.
With Denise, I think that it's important because you can have those exciting conversations that risk is mitigated. You can
Right.
do it with confidence. And if anybody asks you questions, you can authentically, honestly be able to answer it. And you can even address the elephant in the room and bring
Yeah.
that forward to say, I'm sure you're thinking about this, and this is what we're doing about it. So I actually have been creating some short form content, some scripting for short form content. And one of the questions is don't ask about ROI, ask about how you're mitigating risk and protecting the principal.
Yeah. And
You
I think
know,
the questions have
yeah.
been more specific than that.
Yeah.
So that's another thing maybe we can have a conversation about because I'm looking at creating some tools for investors as well.
Once we're talking here about risk, and like you said, we're making people scared now. Maybe I shouldn't invest in real estate. So many high income professionals are highly invested in the public markets, equities, mutual funds, EFTs. So from your perspective, what are the overlooked opportunities with the private sector, for example, private real estate, particularly in multifamily and land entitlement opportunities?
Well, especially so many high net worth people are busy people. They're professionals. They have busy lives. They have families. They don't have a lot of time. Now, private real estate. So the public markets do offer liquidity. That's one thing that they do offer. You can buy a share, sell a share, but they come with a lot of volatility and limited control. Look what's happened over the last week. It's been significant ups and downs in the markets, and it's been happening over the last few months. They're very susceptible to what's the last news cycle? What is the last thing that's been said?
What did Trump just tweet?
Or anybody, right? Oh, we like what Carney said at Davos, markets are up, exchange rates are up. So they're very volatile. There are strategies that can be used to reduce that volatility, and you can have some, but typically money managers of whatever kind don't tend to be able to beat the general market. Okay. Typically the returns are not great. And I've heard lots of criticisms by people saying the market's been going crazy and my portfolio isn't. And I'm going, well, I can't speak to that, but you're subject to whatever's going on out there. Private real estate, on the other hand, when properly structured, offers something different. It offers tangible asset backed investment.
Mortar.
It's brick and mortar. We talk about real assets and real estate, and it's real.
It's real.
I often think about that. We
You
talk
can
about
go see it. You can touch it.
you can come and touch it. You can come and look at the land that we're developing. You can come and look at the walls going up. And it offers multiple levers for value creation and the ability to manage risk. It offers as well the opportunity to leverage because you don't put down 100% dollars. Some people do, and that's fine. That's a different strategy for different people, but typically people leverage their capital on a deal so that the returns are multiple. Many high net worth individuals, they use public markets, but they also use private real estate and private investing. Exempt market dealers offer a way for investors to look at different opportunities that have been vetted by the exempt market dealer and to participate in those because there are lots of securities regulations again that projects need to follow, and some operators don't know them, don't know that they need to follow them, and are putting their project and their investors and themselves at risk. So there are lots of rules around who can borrow money, who can invest money, and on what basis. Land entitlement, which is the projects I'm currently involved in, is interesting because you're creating value through the approval process itself. So we're taking raw agricultural land, a farm that was farmed for 160 years. We've gotten it into the municipal boundary. We've gotten it zoned residential, and we are working on getting it site plan approved. And what site plan approved means is that it will have the designation of the lots on it so that the builder can build on those lots. So we bring it to the point that a builder can do that.
And then you hand over.
And then we
Mhm.
sell it to builders. Yeah. So we're not relying on a market appreciation. Just the fact of doing that does not involve the markets, and it doesn't involve CMHC, and it doesn't involve a lot of things. What it does is it's adding value into the land. So, and typically you can get refinancing and various other strategies, selling lots, selling whatever at each stage because the land has more value and it's at a point where it can be built on. So that's a very powerful diversification tool. And many high net worth individuals, they have money in public markets, but they also have a lot in private markets, in private investments, the top of which I consider very risky is things like shoes and watches and art and whatever.
And music.
But music. But for me, I would like to see something real. As I said, I just have a penchant. Look, built that.
Well, a lot of pension funds, insurance companies are invested in the private markets. So that's
Absolutely.
yeah,
And
yeah,
and they're more accessible to people
yeah.
now
So
through various vehicles.
just to wrap up, if someone listening today is successful in their career, they're financially established, but hasn't yet approached real estate with a disciplined risk management lens, what is one of the mindset shifts, the biggest mindset shift they need to make to move from chasing returns to building durable wealth? And what would you want them to start thinking about differently tomorrow?
Well, I work with high net worth investors to identify and structure risk managed real estate opportunities. And particularly at this point in the real estate cycle, in land entitlement and multifamily, with a strong focus on protecting capital first and growing it second. If so, good investors model returns, but great investors model the downside risk first. Always underwrite to the risk. The upside is the bonus. Not every project works. So make sure that the project you're investing in is that you're underwriting to the risk, not the dream,
Mhm.
as opposed to looking at the ROI. Look at the risk management structure, what's been put in place in terms of the risk assessment, sensitivity analysis, the governance structure, the commitments to communication, and past performance. If you want to build durable wealth, you need to own real assets, not just paper assets, which is the stock market. And many look at it that way. And you need to look past the headlines. So, for example, everybody's talking about how the Toronto market's collapsed. Well, I'm sitting here thinking, wow, that means there's a lot of assets out there available. And so,
Time to buy.
okay.
Yeah.
So
Peop
depending on where you were in the cycle and how badly you were hurt. Is that expression you want to buy when there's blood in the streets. And the Toronto condo market
There's
is
blood there.
not just the condo market. In fact, single family homes, everything is depressed
Mhm.
materially. And the kind of thing that you said about when everybody's running to one place, stop and turn the other way because we've been through this cycle. So the thing is to talk to people who have been successful, no matter what the cycle is, look for actual practical mentors. One of the things this is a pet peeve of mine. Many people stand on stage and offer education and coaching. I don't, I don't think that's your situation. Debbie, you and I have been through this war. When I went through that education and coaching, because I thought I needed that real estate investor education, there was no one talking about risk and risk
No,
management.
it's it's all
Yes.
about everything is rosy and nobody's talking about risk. And that's why I'm so excited today about this topic, Denise. So thank you so much. This has been so powerful. Thank you for sharing not just your strategy, but the discipline behind it.
Sure.
Before we click away, I want everybody to do two things for me. I want you to like this video and hit that subscribe button, because investors who win long term are those who keep learning from people who are actually in the arena, like Denise. So thank you so much, Denise, for being here. I really appreciate it. Every week I bring you real conversations, real strategies, and honest lessons from investors building wealth right now. Some of them you may not want to hear, but you need to hear. So don't miss out our next one. Please subscribe, and I'll see you in the next episode. Stay strategic, stay visible, and keep building wealth with intention. For today, goodbye from Debbie and Denise.
Thanks very much. It was a pleasure to be on here, and I wish everybody every success. That is my goal. I think the world is an expansion opportunity, and everyone can build wealth, legacy, and lifestyle. And so thank you very much for having me on, and I'm looking forward to people reaching out to me. I'm happy to talk to anyone who has a specific question, because it's very difficult on this podcast to cover everything.
And Denise's information will be in the show notes, so everybody will be able to get that.